Hey guys, Jeremy Lindsey here. Welcome to another episode of A Quarter in the Couch, where we comb through life's couch to discover hidden value in everyday conversations. I am a tax strategist, entrepreneur, business owner, founder of Clarity Tax Advisors here in California. And my podcast would not be complete without at least some discussion related to taxes, right? So today, the podcast is going to be a little bit about taxes. We're going to get into the nitty gritty. I'm going to share with you some case studies of success and what I think is going to be really, really good as part of the One Big Beautiful Bill Act that was recently passed by our administration this year. So let's dive in. By the way, I did create a presentation. Feel free to go to claritytaxadvisors.com/resources to download the presentation. Reach out to me directly, info@claritytaxadvisors.com to get a copy of the presentation, or go to aquarterinthecouch.com/resources to see a copy of this presentation as well. All right, let's dive in. So we have a lot of small business tax changes. I'm going to highlight the ones that I think are going to be the most impactful to most of my clients first. And the first thing we got is the difference in R&D expensing, research and development. So before the Big Beautiful Bill was passed, research and development expenses, qualified research related expenses, were required by law to be capitalized and depreciated over at least a 5-year period of time. What does that mean? That means that a research and development expense, R&D, research and development, means that if you are going to improve a process or product mainly, if it's scientific or technological in nature, which includes engineering and or a lab, if the activity is hypothetical in nature, meaning you don't know what the outcome looks like and it's experimental, a lot of these different things qualify for research and development expenses. However, the government did not allow you to expense those as an operating business expense. Instead, what they did was they said, hey, you're engineering a product or service or a process or something like that. That technically is an asset. So we're not going to let you expense that because assets typically get capitalized. Once the asset is created, then you're, as a business, you were able to monetize that. Historically, research and development expenses have been required to be capitalized. What that means is that if you spend $200,000 on qualified research expense developing a product or making improvements to a process or something like that, that you would have to take that $200,000 and divide that $200,000 over a 5-year period to get your annual tax deduction for the year that you apply. In 2025, a $200,000 research and development expense would give you, if you amortize it over a 5-year period, $200,000 divided by 5, right? So call it $40,000 a year. Well, the new rule allows you to expense all of it as you incur it. We no longer need to capitalize it. That's a huge deal. Now, you can capitalize it if you want, and if you want that amortization over at least a 60-month period. The other thing too is this did bring back a little incentive for the R&D credits. So what you're going to see for the people out there that are involved in qualified research expense, what you are going to see is you're going to see an increase in those companies that will give you a research and development study as part of a contingency arrangement, meaning they're going to come in and look at your business financial statements. They're going to talk to you about what kind of qualified research activity you're doing. And then they're going to say, okay, so we think what we're going to do is we're going to charge 18% of whatever credit we come up with. So if we come up with a $200,000 tax credit, we want 18% of that as part of our fee. So I think you're going to see a lot of that. In addition to R&D qualified research expenses being fully deductible in the year that you pay it, this one piece is huge. Not only does this apply for the 2025 tax year, but the One Big Beautiful Bill allows us to go back into previous years and change our taxes retroactively. 2022, 2023, 2024. This is massive. It's a huge deal. So yes, you could go back and amend your tax returns. And instead of electing to amortize the research and development expense, we can capitalize the research and development expense. We can now expense those all out in the year in which you did that. So definitely a huge deal on the R&D activities. One of the other big things that came out of the One Big Beautiful Bill was IRC Section 179 expensing. This is everybody's favorite code section. You go buy a truck or some piece of heavy equipment that's over 6,000 pounds, you get to expense it under IRC section 179. Now, previously, the 179 limits were $1 million a year. That threshold increased to $2.5 million a year effective for 2025. So if you buy a vehicle in 2025, or if you buy 10 vehicles, $250,000 a piece, the 179 expense limitation is $2.5 million, up from $1 million in 2024. That's a huge deal to all my people that are buying big pieces of equipment or buying a lot of cars, et cetera, et cetera. Along the lines of the 179 is any improvements made to a commercial building that would normally not be subject to qualified improvement property deductions. But I have one client in particular who just replaced a roof this year. That roof is not subject to qualified improvement property rules. However, that roof does qualify under the 179 expense because the roof was qualified accelerated depreciationable. So in addition to that, we have the bonus depreciation that came out under the One Big Beautiful Bill as well. Bonus depreciation differs from 179 accelerated depreciation. When you do buy a car and you 179 expense it for 2024, we were only able to get a 60% deduction on that. The bonus depreciation is what governs that percentage depreciation. Historically, that's been, for 2022, it was 100%. For 2023, it was 80%. For 2024, it was 60%. For 2025, it was scheduled to be 40%. But the new bill has made this deduction permanent, and now we are able to take 100% bonus depreciation deduction on it. So bonus depreciation and 179 are brother and sister. Bonus depreciation takes all of the expenses on a truck or a heavy equipment, adds that all together. The 179 threshold is where that then kicks in, and it caps out the bonus depreciation amounts to $2.5 million. Big deal for a lot of my business owners. Now, the next thing is the changes that came out in the qualified business income deduction. So when Donald Trump's first term was here, he installed the Tax Cuts and Jobs Act, and he gave C corporations a 20% corporate tax rate. Flat tax, no questions asked. It's 20% from the start. It's 20% for $200 million in net income. Doesn't matter. There's no graduating scale because, quite frankly, most C corporations are used by very large businesses, and graduating tax system doesn't really work because all the numbers are well over all of the graduating amounts. A lot of people petitioned and said, hey, wait a minute, you did this for C corporations, but you didn't do this for S corporations, LLCs, or other pass-through entities. What are you going to do for them? Because now you're going to incentivize everybody to go over to C corp. So the administration's answer was, we'll give a 20% deduction for qualified business income. Now, qualified business income is where a business owner, a small business, is in business, whether it's an LLC or an S corporation or any pass-through for that matter, whether it's a partnership or Schedule C even or anything else like that. They'll give you a deduction for 20% of the net pass-through income that you're going to file on your return. I'll give you an example. I have an S corporation. That S corporation made $100,000 in net profit. My qualified business income deduction is 20% of that. So I don't have to pay tax on $100,000. I pay tax on $80,000, or I get a deduction for the 20% of the $100,000, and I only pay tax on the 80. This was scheduled to be phased out in 2026. The One Big Beautiful Bill made it permanent. And in addition to that, it increased the threshold amounts. Now, as with most tax considerations or quote unquote tax breaks, there are income threshold limitations, meaning if you make too much money, you're not going to be able to take advantage of this. Now, where are those thresholds? If you are a specified service business, or if you are a business that relies on the intellectual property of a human being, like a service business or a broker or an insurance company or something like that, your qualified business income deductions start to phase out at $394,000 of net profit. Okay. So anything over $394,000 in net profit, your deductions start to become very, very limited. And then eventually, after about $1 million or so, they are wiped away completely, and you don't get the qualified business income deduction at all. However, if you're a construction company, if you're a manufacturer, or if you are involved in a specified service, trade, or business, then the thresholds don't apply to you. So, which applies to a lot of my clients as well. Now, the qualified business income deduction allows for more small business owners to take advantage. The increased phase out thresholds go from 50K to 100K, from 75K to 150K. And that means that your thresholds, the $394,000 increases, and you're able to show more net profit to take advantage of this qualified business income deduction. For 2024, I actually came across the client for the first time where by optimizing his qualified business income deduction, we actually saved him $40,000 of income tax. I was surprised. I was shocked. Basically, the way that qualified business income deduction works is not only do you have to have your net profits within a certain threshold, but you also have to qualify to make sure that you've paid yourself a reasonable wage. So there's wages associated with it. Or I should say, you have to have qualified tangible property. Qualified tangible property means you have heavy equipment on the ground, you have machinery, assets, whatever that is, you have a value of a building or a business or something like that. So if you don't have the wages, let's say you have a rental business, but you don't have many employees, you can still take advantage of this because the equipment that you're renting out gets used as part of the qualified business income deduction. So in order to maximize the qualified business income deduction, the way the qualified business income deduction works is it says, okay, so we're going to take 20% of the net profit of the business, but then that 20% is the best deduction you can get. However, it is limited to 50% of the total wages that you paid or 25% of the qualified tangible property that you own. Let's break this down into an actual hypothetical. If we have a client that makes, let's say, $1 million a year in net profit, pays himself 150 grand. The $1 million a year net profit would be 20% off of that $1 million would be a $200,000 tax deduction. But he only paid himself 150 grand, which means we get the limitation of either 20% of a million or 50% of his wages is $75,000. Okay. Now, you see how that can create a substantial tax discrepancy. Now, if we were to modify that person's W-2 income from $150,000 to what's half, $200,000 is half. So we're going to modify that to $400,000. Okay. $400,000 now becomes his wages. $1 million drops to $800,000. Okay. So understand that when we raise the wage, we decrease the net profit because the wage is a tax deduction for the business. Okay. Follow me here because it's going to get a little hairy, but there's a sweet spot. So if we say the $1 million of net profit drops to 900 because we added $100,000 in wages. So then 150 goes to 250. Half of 250 is 125. Half of 900 or 20% of 900 is 180. So now we have a little bit more wiggle room. So now we're going to peel off another 50 grand. So 900 drops by 50 grand because we're adding $50,000 in wages. So now we have 300,000 in wages and $850,000 in net profit. Well, 50% of 300 grand is 150,000. 20% of 850,000 is 170,000. So now as we start to optimize this, you guys can understand that, hey, wait a minute, our qualified business income tax deduction is actually giving us 20% back into our pocket. Okay. Now, for those skeptics out there, you say, well, yeah, Jeremy, you're increasing the W-2 to maximize the qualified business income deduction. Don't forget payroll and Social Security tax, right? Well, guess what? Payroll tax, the massive part of payroll tax is the Social Security part, which is 15.5% of your W-2. The rest of it is Medicare tax, unemployment tax, et cetera, which adds up to about 17.6%. Now, if you pay yourself above and beyond the Social Security wage gap or the cap, which I think for 2024 was 168,500, that threshold changed for 2025, I'm pretty sure. Anything over $168,000 is only taxed additional of like 2.5 or 3% max. So if you're saving 20%, rounded, paying 2%, your net savings is 18. By maximizing the qualified business income deduction, you're getting free income. This is a huge deal. Now, it works with the same thing as far as the unadjusted basis of tangible personal property, i.e., trucks, other assets that you have, heavy equipment, machinery, tractors, trailers, etc. All of it's added up to be used to maximize the qualified business income deduction. So you need to maximize the qualified business income deduction big time. It is low hanging fruit. It is super easy to maximize, and it's so important that this happens. Now, you want to make sure that if you are an S corporation, it is only for the profits. The owner's salary does not qualify for the qualified business income deduction. However, the owner's salary is included in the calculation. For the LLC, the calculation is a little different because if your LLC net profit happens to be fully subject to self-employment tax, then your qualified business income deduction gets a little different. So be sure to check in with your tax advisor or shoot us an email and we can show you how that can apply to you. The other aspects and ways to maximize the qualified business income deduction under the One Big Beautiful Bill Act is to make sure that your income, especially if you're a specified service business, make sure that your income stays below the $394,000 threshold. Okay, that threshold has changed now to $545,000. How do we do this? Well, we accelerate expenses, we defer income, or we contribute to a retirement plan, and we spend more money at the end of the year, et cetera, et cetera. So if we're right on the brink of that $500,000 threshold, $400,000 threshold, and we're sitting on some cash, it might make sense for us to take that 179 because we want to build our asset base so that we can maximize the qualified business income deduction. It might make sense to bonus our employees a little bit more so that we can have a higher wage base for the qualified business income deduction threshold, get that lower tax deduction. So we want to make sure that that qualified business income deduction is definitely maximized. Retirement contributions and benefit plans help with that. And the small business listeners, when I'm talking small business, I'm talking $2,000-$3,000 in net profit on a Schedule C. The OBBA introduced a minimum deduction of $400 for participants with at least $1,000 in qualified business income. So if you did $1,000 in net profit, your minimum deduction is at $400 or 40%. If you did more than $1,000, then obviously it's subject to $400 or 20% of whatever the deduction is. But your minimum deduction for QBI is now $400. Big deal. Moving on to the next best thing that came out of the One Big Beautiful Bill Act. Changes were made to the qualified small business stock exclusion. Now, what is the qualified small business stock exclusion? If you are a C corporation and you are the founder of a C corporation and you receive the stock as part of the creation of that C corporation, you are entitled to a qualified business stock exclusion. Let me break this down a little further. You created a C corporation. You are not a specified service, trade, or business. Okay, IRC Section 1202 has a couple of definitions. It goes back to accountants, attorneys, lawyers, doctors, engineers, insurance companies, brokers, etc. These types of businesses do not qualify for the qualified small business stock exclusion. However, all the other businesses do: manufacturing, construction, et cetera, et cetera. So you create the C corporation, you hold the C corp stock for a 5-year period of time. You are able to sell that C corp stock in a merger and acquisition or through a sale, like you're going to sell your business, and the buyer buys the stock from you instead of buying the assets. When you sell that stock, you get a 100% capital gain exclusion, meaning you do not have to pay tax on that money. So how does that work? The IRS says, hey, wait a minute, this isn't just like a free lunch. So we're going to build some guardrails here. What are the guardrails? Well, number one, can't be a specified service, trade, or business, i.e. insurance, et cetera, et cetera. Number two, there's 2 ways to calculate the gain. If you have basis in the C Corp stock, i.e. you put $1 million of money into the C Corporation, you get 10 times your basis or $10 million in sale proceeds tax-free if the assets of the business are $50 million or less. Let's go through a little bit more in detail. So going back to a hypothetical case study, client puts in $1 million into a C corporation to establish a company, or converts an S corporation to a C corporation And the stock basis that he had or she had in that S corporation was $1 million at the date of conversion. That C corporation then seasons over the next 5-year period. And within that 5 years, the total assets of the company do not exceed $50 million. The client decides to sell that company, but instead of selling the assets, they're going to sell the stock for $20 million. That $20 million, we are limited to the exclusion of either $10 million in gain, i.e., the difference between basis and the sale proceeds, or 10 times basis, $10 million. Now, OBBA increased the threshold from 10 million to now 15 million. And if you decide to do that, you only get to use that one time in your lifetime. Now, that one-time use is tied to a social security number. So your wife is entitled to the same thing on her ownership interest of the business. If your son or kids own the business and they receive proceeds, they are also entitled to their own threshold limits. So it could very well be that you could sell a company for $50+ million with 5 different shareholders, i.e. all of your family members, and nobody has to pay taxes on the sale because of the qualified small business stock exclusion. Well, now that 10 million increased to 15 million, and it went from, on 5 people, $10 million a piece, 50 million, up to now 5 people, $15 million a piece. That's a $75 million exclusion. That's a big deal. Now, one of the things that the OBBA did also was investors can now receive partial benefits if they want to sell sooner than 5 years. So it's not 100% exclusion, but you do get some exclusion, and the qualified business stock exclusion was made permanent. This is a fantastic, awesome strategy for people who are looking to sell after 5 years of holding time. Our next big benefit out of the One Big Beautiful Bill Act, opportunity zones. Again, 2017, the Tax Cuts and Jobs Act created by Donald Trump included a provision and expanded out the opportunity zones, whereby you can take a capital gain event. Let's say that your crypto has made $1 million, $2 million, $3 million, whatever. You could sell your crypto, and as long as you have funded all of the gain of that, all of the proceeds of that sale into a qualified opportunity zone or a qualified opportunity zone fund or something of the like, that gain gets deferred until 2026, i.e. next year. So if you had a gain that happened in 2017 and you took advantage of the opportunity zone fund deferral, you don't have to pay tax on that until 2026. Now, along the lines of opportunity zones, the previous law says that if you held the opportunity zone for 10 years and you qualified as an opportunity zone for all of those 10 years, when you go to sell that asset, that sale is also tax-free. Okay. So that's a huge deal also. Now, how did the OBBA change that? Well, they made Opportunity Zone program permanent, and they extended it from 2027 onwards. So if you have a capital gain event in 2025 because the crypto market took off, you can take that deferral, or you can take that gain, you can take all the proceeds, and you can drop it into a qualified opportunity zone or a qualified opportunity zone fund on the stock exchange. And then that deferral, that gain, you want to pay tax on that gain for at least 5 years. And what I've seen clients do is they'll take $1 million gain and they'll take $200,000 and put it into one opportunity zone that vests and is sold the very next year. They'll take another $200,000. They'll put that into an opportunity zone that has a maturity date of about 2 years. Then they'll take another 200 at 3 years, another 200 at 4 years, another 200 at 5 years. Basically, what that does is that takes $1 million gain and that spreads it out from a tax purpose over a 5-year period where you're recognizing $200,000 a year over the next 5 years. Why would you do that? Because the capital gains tax brackets are much more advantageous than the marginal tax brackets. However, when you receive a full lump sum $1 million, your marginal tax brackets get hit much faster because that's part of the calculation. So you would want to spread that gain over a 5-year period to maximize your marginal tax bracket system. So in addition to the opportunity zones being extended and made permanent, Opportunity zones will be redesigned every 10 years at least, and will carry in and of itself a 5-year deferral period every time. So, plus, there's been new incentives for rural areas because rural areas are it could be seen as poverty-ish or below the poverty level. And because of that, that incentivizes investors to come in and take rural areas and develop them into bigger cities. The opportunity zone, by the way, was invented or considered from natural disasters that occurred in New Orleans, Louisiana, and the Gulf. It seems like the Gulf gets hit all the time with hurricanes, Hurricane Katrina, all this stuff. And so to incentivize investors to come in and rebuild, opportunity zones were created to incentivize those investors to come in with big money and rebuild those areas for all those tax treatments and tax breaks, so that the rebuilding of a city or a region does not simply land or fall on the government. The government and the regions of opportunity zones have seen incredible success with the opportunity zone tax incentives all day long, every day, and we will continue to see that. One of the other big benefits, and this is definitely going to be a planning consideration for what I do for my clients going forward, is the employer provided childcare credit threshold was increased from 25% to 40 or 50%. The credit cap has also been raised from $150,000 to $500,000 for small businesses and $600,000 for larger businesses, effective 2026. So starting in 2026, my clients can now pay $10,000 because in 2025, the credit is limited to $5,000 or 50%, whichever's more, for small business. So basically, what it looks like is if I pay for qualified childcare for my 3-year-old son, let's say that I pay $12,000 a year for that. I would normally only get 25%, which, by the way, also gets thresholded out if my income is too high. So it might not be the best advantage. However, with these new laws and with the new OBBA, there's new higher caps and there's new thresholds and things like that. However, basically what it looks like is if in summary, I pay $10,000 in child care costs, I get a $5,000 child care credit. And if my tax bracket's at 35%, that a tax credit versus a tax deduction. Tax deduction reduces taxable income. A tax credit reduces tax owed. Okay. I would much rather have a tax credit than a tax deduction. Okay. Because whatever tax I owe, my tax credits actually pay my tax for me, dollar for dollar. Whereas a tax deduction reduces my taxable income by a percentage. So if I am getting a $5,000 subsidy from the government via child tax credit, that means that I can recognize anywhere between $10,000 and $15,000 of taxable income that I don't have to pay the child care credit, not child tax credit. Those are different. The child care credit will go to pay the tax on that extra income. So there are some steps that you need to take in order to qualify for this. And the biggest one is you have to provide this as an employee incentive to everyone in the company. You cannot discriminate. Okay. So consider this as part of the compensation planning when you're looking at total employees all over the place. Is the majority of your employee team, do they have a lot of young kids? Do they have a lot of Medicare or childcare expenses? And maybe this is something that the company should take on as part of a fringe benefit package so that your employees don't have to pay tax on that income. The business gets the credit, the business gets the deduction, and your employees have to can recognize a lower income threshold, thereby lowering their income tax, increasing their taxable refunds. Something to definitely consider. I think this is a powerhouse move for 2025 and beyond. Something that I will be definitely looking at for all of my clients on a go-forward basis. The next change is the business interest deduction limitation under IRC Section 163J. Now, this is going to apply to a few of my clients. The business interest deduction limitation only applies to businesses that have a gross revenue, an average gross revenue of $25 million or more for the last 3 tax years. Okay. So if you are under that threshold, fast forward this section and move on to the next tip. However, if you are over that threshold, which a handful of you are, this will definitely apply to you. The current deduction limits the interest expense to 30% of adjusted taxable income. The new deduction increases that threshold because now the change in the ATI calculation takes out and will exclude depreciation, amortization, and depletion. That gives us a higher threshold. That gives us the ability to have an increased level of business interest deduction. This is a big deal. Now, this is also on a go forward basis. It's not retroactive for the R&D. Definitely something that's going to have an impact on my bigger clients. A couple other notables that I think is big deal is the OBBA changed the filing threshold for your 1099 filers. What does that mean? That means that previous, you'd have to file a 1099 for anybody who received a payment of $600 or more for services or products rendered to your company. For 2026 and beyond, that threshold increased to $2,000 per payee. So that's a big deal. The reporting threshold for 1099K forms also increased from $2,500 to $20,000 and 200 transactions, effective this year, 2025, and beyond as well. What the government had in mind is they intended to reduce the administrative burden for small businesses, allowing them to focus more on growth and operations. Quite frankly, about 3 years ago, during COVID, everybody knows that the IRS deleted 32 million information tax returns only. Okay, so because they didn't have the manpower. So 32 million forms, information only forms, things like the 1099 stuff. The IRS just basically said, we're just going to delete all those emails like they never existed. Now, if you get audited, those 1099s will come in handy. We continue updates with the OBBA with our discussion related to excess business losses. Excess business losses has been a very surprising Achilles heel for the tax preparers and professionals. What is an excess business loss limitation? Let's take an example of a highly paid W-2 earner making $1 million a year. They go and they start a business to try to offset that $1 million income. For purposes of this case study, that the income numbers are a little higher. So $1 million of W-2, and we have $1 million worth of losses coming from a business. Okay. The law established in 2017 under the Tax Cuts and Jobs Act, very surprised to me. The law says that any business losses that are in excess of X of the threshold, and for 2024, that was $640,600 for married filing joint people. If your losses are in excess of that, you cannot take those losses. Those excess losses get rolled forward to the following tax year, not retroactive, future active. So if you had losses in 2024 that you couldn't take, you had excess business loss limitation, you can now take those in 2025, subject again to the limitation. Now, this is only on business losses. So what it does, however, is all of your business losses are netted against all of your business income. And if your net is still in excess of $600,000 or $700,000 net of the threshold, or if all of your net is still in excess of the threshold, then your excess business loss kicks in, and that excess loss gets pushed to the following year. It was supposed to expire in 2028. It is not. It is now made permanent, and it is a permanent part of our tax code. I've had this discussion with a lot of people, and they say, well, if I sell an asset or if I sell a business, is that gain included as far as the net when it comes to the excess business loss? So let me give you an example. Here we are throughout the year, and so far this year, a business has been losing money. And so the client decides that they're going to sell the business. Let's say they sell the business for $1 million. To be honest with you, I don't know what kind of company can sell for $1 million when they're losing money, but follow me here. Now, let's say that the business generates a $200,000 loss and the sale of the business generates $1 million gain. Okay. In theory, you'd have a $800,000 net income. That's true. But what if you had $1 million of excess business loss in the past? That would carry forward. And now you have $1.2 million of excess of business losses with $1 million of gain from the sale of a business. Your net would be negative $200,000. However, if that gain is not business related, let's say it's the sale of crypto or something like that. If that gain is not business related, your $1.2 million of excess business losses would be subject to the thresholds. You'd only get $600,000, and the $1 million of capital gain would only be offset by $600,000 of business loss. However, if the sale of an asset is related to the sale, if the capital gain is related to the sale of a business asset, either into intellectual property or intangible property, goodwill, et cetera, then those technically, and it needs to be reported on the correct form on your tax return. Otherwise, this excess business loss will kick in. If it's not reported on the right form, your excess business loss will not offset it. If it's reported on the right form, your excess business loss will offset the sale of business-related assets. So definitely something to keep in mind, take into consideration. And I think the big takeaway for this is this has been codified and made permanent, and we can now take this into consideration when it comes to long-term tax planning. It's not going to be up in the air, and it's not going to expire. Some other notables, the clean vehicle credits are set to expire. All credits end after September 30th, 2025. The current credit amount is $7,500 for new vehicles, $4,000 for used vehicles, and $40,000 for heavy trucks. Obviously, don't make purchase decisions based on tax law. If you're going to buy a car anyways, cool, you'll get the credit. Don't let the tax tail wag the income dog or the expense dog ever. Other notables, alternative fuel refueling credit. Taxpayers currently can claim a tax credit of up to $30,000 for installing alternative fuel refueling property, i.e. hydrogen or something like that. That refueling credit will be discontinued after June 30th, 2026. Doesn't really apply to a lot of my clients, but somebody listening, you might want to take that in consideration. Changes were made to the paid family and medical leave credit. The credit percentage increased from 12.5% through 25% under the previous temporary credit to now it's 40 to 50% under the new permanent credit. The higher credit caps for big businesses that are paying this family leave, family and medical leave to their employees. $150,000 cap for businesses, up to $500,000 for larger businesses, $600,000 for small businesses, starting effective 2026. The credit applies to wages and insurance premiums, so something to definitely consider. Advanced manufacturing credit. A credit is now available for investments in advanced manufacturing of clean energy technology like solar, wind, batteries, and critical materials. However, the OBBA did restrict those investments to U.S.-based investments. There are definitely substantial restrictions on foreign-based investments and foreign entities doing that. The corporate charitable contribution deductions have changed. For big C corporations, historically, a C corporation can deduct up to 10% or up to 5% of its adjusted gross income as a charitable donation deduction. This change said you can't deduct anything less than 1% of your taxable income up to a ceiling of 10% of your adjusted gross income. So if it's less than 1% of your income, you can't deduct it. So make sure that it's a little bit more than 1%. If it's more than 10%, you can't deduct it. It gets carried forward. This change will require corporations to contribute more charitable causes before they can deduct those contributions from their taxable income, effectively increasing the minimum threshold for this deduction. Now, for those of you who have buildings, commercial buildings, rentals, property, etc., there's changes made to the energy efficient buildings deductions. Deduction for qualified energy efficient building improvements like windows, HVAC systems currently allows businesses to deduct the cost of making energy efficient improvements to their building. However, this deduction ends for property started after June 30th, 2026. The deduction will no longer be available for the new energy efficient building projects started after June 30th, 2026. The employer provided meals deduction was made permanent. However, don't get excited. There's a very select few people that this applies to. The One Big Beautiful Bill Act is allowing for 100% deduction for employer provided meals. Now, again, before you get all excited, it only applies to restaurants, catering services, and the Alaska fishery equipment or fishery establishments. Applies to meals, not snacks or beverages. So only food, and it replaces the previous non-deductibility. So prior to 2026, employer-provided meals were not deductible as a business expense in any of these three areas. This new rule now reverses that change. So I want to go through a couple of case studies on how all of these things work. We have a general contractor who's making $1 million a year with a net profit of $500,000. Okay. Now the company is either an S corporation or an LLC for matters of this discussion. That company can now go out and buy a new truck, and they get a 100% deduction for the asset that they purchased instead of a 40% deduction that they purchased. That threshold has now gone from $1 million up to $2.5 million. Okay, so if they wanted to spend $2.5 million on stuff, they would only be able to take all of the net profit up to $2.5 million to offset that. That's where the 179 limit comes in. The 179 limit is $2.5 million in annual assets purchased, which can be expensed, with phase outs starting at $4 million of purchases. So as an example, if several purchases qualify, like forklift, IT systems, security, things that would normally need to be capitalized, all can be immediately expensed under IRC Section 179 up to the full $500,000 net profit. Now, if you have more than $500,000 net profit, remember the threshold is $2.5 million. So if you have $2.5 million of net profit and you're sitting a lot of cash and you want to spend a lot of money on forklifts, IT systems, security, a lot of 179 bonus depreciable assets, definitely do it. The strategy is that the company can combine the Section 179 and bonus depreciation for a maximum tax deferral of up to $2.5 million starting in 2026. Same construction company, we're maximizing the qualified business income deduction. So if we have $500,000 in net profit, remember that qualified business income deduction is 20% of $500,000, or in that case, it would be $100,000. We want to make sure that the wages are at least $200,000, or the unadjusted basis of tangible property is within those thresholds to maximize the qualified business income deduction. And again, basically, that's just free money. Let's assume, going back to this case study, now that employer decides to offer childcare to all of his employees, which he only has two, himself and a administrative person. The company can then pay his childcare provider directly for childcare-related costs, and the company now takes a 50% tax deduction for it, effectively paying the tax on the income that he may have had to recognize for the childcare credit. Again, this is definitely something that I'm going to be looking at for my clients to see if we can integrate this, make it part of a executive compensation package or a fringe benefit package, offer it to all the employees associated with the business. This definitely might make sense. Maybe even consider, instead of giving somebody a raise for 2026, maybe install this fringe benefit. And if it would apply to them, or if it would help them. I know a lot of people these days have kids under 5 years old, and they are required to provide childcare while they go to work. This has been a big summary. It's been huge, and bear with me. There's a lot of stuff going on with the OBBA. What I would encourage you to do is, if any of these resonated with you, reach out to your tax advisor to see how all of these changes can apply to you and be proactive with your tax strategy. Now, if you don't have a tax advisor, reach out to us, claritytaxadvisors.com and/or aquarterinthecouch.com/resources to learn more information about how you can set up a free consultation with me, and we can get into the granularity of your business. I hope today's episode brought you several quarters in the couch. I know it did for me. And when I looked at the One Big Beautiful Bill Act, I think the biggest takeaway for me was that childcare credit. I think the big deal was the expensing of the R&D credits, our new thresholds for 179 and bonus depreciation. I know a lot of my clients are going to take advantage of that. Now, I want you to resonate on this and decide whether or not you need to take action on a 2025 tax plan. If you do, feel free to reach out to me, claritytaxadvisors.com. Schedule a free consultation, and/or just shoot me an email, info@claritytaxadvisors.com, and a member of my team will reach out to you for sure. Until then, I hope the quarter in the couch, you found value today. I hope you found a quarter in today's couch. And if this episode was helpful, hit the like button, hit the subscribe button, and send this to a friend who's going to be able to take advantage of all these tax deductions. I'm Jeremy Lindsey, and I'll see you on the next episode. Until then, have a great day.